I'm doing this video at night to share with you some news about REITs. I know some of you have bought and are quite concerned because REIT share price has been dropping, correct? Especially one that I've shared openly, which is Mapletree Industrial Trust. From comment sections, I know many of you guys, first time seeing such a bad downturn, are really affected. But on the other hand, there are also some who are rejoicing at picking REITs on the cheap and are really looking long term. So for today, I have two particular articles to run through with you. Hopefully it can give you a lot more clarity and hopefully it can give you a lot more resilience. We don't know what's the road ahead, but if it's bumpy, let's ride it together. Hi guys, welcome back. Let's start with JPMorgan's article first with the title "As Recession Fears Rise and Risk-Free Rates Drop, as REITs Could Benefit." Let me pause there first. JPMorgan is the one that gave a 190 share price target for Mapletree Industrial Trust, right? Then suddenly they're flipping to say that as REITs could benefit. Maybe they just don't like Mapletree Industrial Trust, or maybe they are just flagging out something specific to data centers in US. As always, we read different viewpoints to make our own critical judgment, correct? So let's read what they have to say. Although as REITs are unlikely a place to hide during a recession, they reckon that a faster than expected drop in Singapore benchmark rates and 1-month SORA rates may see investors rotating to defensive yield plays. Let's take a pause over here. REITs can be volatile, they are not defensive. But to the point on unlikely a place to hide during recession, that is true because I'm afraid coming up, people are going to say, oh, recession risk, REITs give a consistent dividend, buy REITs, hide in there. That is wrong because REIT dividend can suffer in recession. I'm a REIT shareholder and I'm giving you a balancing viewpoint. So not only that, I built up a chart to show you what are some of the biggest REITs in Singapore. And as always, this has taken our team hours to prepare. Smash the like button, show us your support, press the subscribe, and thank you very much. This screenshot over here is not covering all REITs. So if I've omitted your own favorite REIT, don't take offense to it. But let's hear what are some viewpoints. On the left hand side, I pasted in REITs which may be the most impacted, especially if the recession starts from US side. As we know, if US catches a cold, the world would sneeze, including Singapore. Then as we progress right, I'm trying to show you what are REITs that are likely more resilient in a recession, and I'll explain why also. So let's start on the left. Manulife US REIT, Prime US REIT, and United Hampshire REIT are all US based. If US has recession, offices there would suffer, correct? And if you've been following this channel, I've sounded out. US offices are very different from Singapore offices. Most of us are back to office already, but there, the culture seems very different. Still very resistant to going back and still wanting to work remotely. So that's why the office space could yet see more hits if there's a recession. Of the three names, probably United Hampshire is the least affected because from what I remember, they own malls and then that should still be bread and butter. Then let's move to some names in the second column. Ascott Trust, Far East Hospitality, and CDL Hospitality. This is a category of REITs who own hotels. I put them next to the US offices ones because these, in my opinion, will get impacted if a recession hits. The logic is very simple. When recession comes, business travel will cut. You will realize that hotels need business travel to get good occupancy. And in any case, when there's recession, we have less money to spend. We don't go traveling that much. That's the reality. And therefore, if you study enough on history, you would realize that these REITs can be volatile in a recession period. They are not the buy and hold kind. They go through cycles. I own Ascott Trust and I know it fully. Hotels in Japan, for example, are still doing very well. But if a recession hits, I can't be too certain that their profitability will not be affected. At least they are still in the space of doing more long-term stay. CDL Hospitality and Far East Hospitality are more day-to-day stay if I'm not wrong. So again, when you buy a REIT, understand its business model. Then in the third column, I have on top Mapletree Industrial Trust, Keppel DC, Lendlease, Suntec, and Keppel REIT. These will not be too affected by a recession in my opinion, and I'll explain why. And if you're looking for a fantastic platform to buy Singapore stocks, Hong Kong stocks, and also US stocks, check out Moomoo. As a Moomoo user myself, what I love about it is that it has zero commissions for Singapore stocks such as any of the REIT that we'll be discussing today. It really helps keep costs low. Instead of going through lengthy financial reports, Moomoo gives me all the key data I need in one place. For example, revenue breakdown, financial estimates, chart of financial statements, dividend yield, which makes all the analyzing of a stock so much easier. Plus, Moomoo gives free access to analyst rating and Morningstar research so that I can see expert insights and make better investment decisions. Moomoo also has powerful trading tools that you can use also as an investor. You can see their price charts clearly and you can see all the comments and latest news. If you're buying Hong Kong stocks or US stocks, you would need to do currency conversion, correct? And with Moomoo, it's very simple. That's what makes a great trading experience. And with that, if you're new to Moomoo, you can use my sign up links below in the description to get $820 worth of new sign up rewards, including up to $450 worth of Tesla stocks and an exclusive $20 trading cash coupon just with my link. So what are you waiting for? Look for my links below and don't miss out on it. Mapletree Industrial Trust. Their leases are typically a few years. But again, if recession hits US, they have data centers over there, correct? They could see occupancy dropping a little bit. It's true, but they are also diversified to Asia data centers and also Singapore industrial buildings. Singapore industrials, I think that's pretty resilient. Then second, Keppel DC Reit. While Keppel DC is more diversified globally in data centers, their business model is more for co-location, which means their leases are very short. If a global recession hits, you would realize occupancy could drop. Then up next is land lease. Land lease has Singapore malls, like 313, like Parkway. These are pretty resilient, but I think their Euro offices part, that one not too sure. Then up next is Suntec, and I'll lump them together with Keppel Reit, because these two are very similar. They are mainly in Singapore and they have some in Australia. Australia right now, the economy isn't doing too well. Mining sector has slowed down there and office rents are not as strong. But for these two REITs, the bulk of it is in Singapore and grade A offices. Suntec, of course, there's Suntec Towers. Keppel Reit, they own Ocean Financial Centre. So if a recession hits, I think impact will be slight. So that's why I've lumped them in this third column. And with that clear, let's move on to the final column on the right, which are REITs that could be the most resilient in a recession, especially a global one. Right at the very top, Parkway Life Reit. And the reason is because Parkway Life Reit is in healthcare. I'm not a super fan of Parkway Life Reit, but their numbers have still been strong. And as we know, healthcare is essential service. And they own the best hospitals in Singapore. I'm a bit more concerned about their Japanese assets, and in particular their new ventures into France. Based on the properties they own, which are hospitals, super resilient. Then also in that column, you see Frasers Centrepoint Trust, which owns Singapore malls, Tiong Bahru Plaza, Hougang Mall, Causeway Point, you name it, but they usually lock in tenants for 1 or 2 years. And that should tide through a recession. These are super resilient in my opinion. Recession comes, don't worry, the mall is still full. I just don't know how much the consumer will be spending. And then next is Ascendas Reit. Ascendas Reit is very diversified. They have industrial parks, they have business parks, and right now they have data centers. So as compared to Mapletree Industrial, they are a lot more diversified. Then up next is CapitaLand Integrated Commercial Trust. They own Plaza Singapura, Raffles City. The bulk is in Singapore assets. Global recession or not, I think these malls, these offices are still going to have tenants, and I don't foresee too much problems with occupancy. Then last but not least, Mapletree Pan Asia Commercial Trust. I own this, and I was thinking whether to put it here or in the third column. They own VivoCity, which could get impacted if tourism drops. But all in all, I think their assets are in Asia, and the risk for Mapletree Pan Asia is whether some of its overseas assets can do well. Having said that, maybe with global recession, their Japanese offices will do worse, their China offices will do worse. So I could place them here or I could place them in the third column. Let me know your thoughts in the comment sections below. And as always, if you want, you can take a screenshot of this and prepare your war chest cash if there are opportunities to buy REITs. Against this backdrop, JPMorgan expects a 15% upside to S-REIT's September 2024 highs. Really? Again, you're the one who said that Mapletree Industrial Trust target price cut by 20%, right? Never mind. Maybe you're referring to the overall index, which means if I were to understand this correctly, JPMorgan believes that REITs could recover back up to around here, 1,250, which is 25% from now. Because the index for S-REIT leaders is 1,000 what? 15% above September? That means a 25% upside. Hopefully they don't flip-flop on that and hopefully that materializes. But again, stay patient. It will not go up in a straight line. Don't have that kind of expectation. So let's continue reading on. Right now, JPMorgan says that there could be 2 or 3 Fed rate cuts by year end, and economists are highlighting a 40% risk of US recession this year. Personally, I think that's a stretch. Recession takes time, but what do I know? They are economists, so maybe they are smarter. They estimate that there's 4% upside to S-REITs DPU for every 100 basis point, which is 1% fall in floating rates. REITs own properties, and it's like, you own residential floating rate. If the rate drops, you pay less in interest costs, which means you have more money to pay for dividend. Usually, again, REITs, they sign multi-year leases, which means the income is guaranteed already. If the cost drops, of course, there's upside. And they anticipate that S-REITs will revise down borrowing cost guidance. If this is true, I think it's fantastic news. I believe analysts will start re-rating REITs as a sector if this builds momentum. As of now, can't guarantee it. And anything I mentioned again today is not financial advice. It's just my sharing as a fellow investor. And also soothing words, especially if you've been long suffering, holding some REITs and waiting for that bull market. I have been too, but I'm also not losing sleep over it. Top names that they've picked: CICT, Ascendas, Keppel DC, Frasers Centrepoint Trust, and Mapletree Logistics Trust. Luckily, they didn't put my Mapletree Industrial Trust there. If not, it'll be a 180-degree U-turn, which will look awful. But never mind. I have a bit of CICT. I have Frasers Centrepoint Trust. S-REIT borrowing costs should trend down, with 2/3 of S-REITs at or above stabilized borrowing costs. Good news. In particular, lower floating rates could benefit S-REITs with high proportion of floating debt, like CDL Hospitality Trust, and those with larger proportion of SGD denominated debt, like Frasers Centrepoint Trust. Again, I like Frasers Centrepoint Trust, but if interest rates come down because of recession, I think it's a plus for CDL and a minus also. So I'm not too sure if that's a great idea. Additionally, coupons for S-REIT bonds have fallen to 3-year low of 3.2% from reduced spreads, and S-REITs are relatively more attractive based on yields of 6.3% compared to banks' 6.2%. To this, the caveat has been banks pay 50 to 60% and REITs pay minimum 90%. Okay, to that point, I need to pause and explain things a bit. When we invest for dividends, yes, we may be looking for the best dividend yield. Again, that would be the problem of comparing apple and orange, even though we want fruits. This 50 to 60% payout rate and 90% is a price earnings perspective, and it cannot be compared like that. Just like we can't compare REITs and banks to tech, because many tech companies don't even pay dividends. And it doesn't mean that they are lousy. And that's because most business, excluding REITs, which is a trust structure, retain earnings for expansion, correct? Tech companies retain their earnings so that they can invest into R&D and keep building market share. Banks, they retain 40 to 50% so that they can do future expansion. If you see our 3 banks, they've been acquiring overseas assets. Recently, UOB bought Citibank's assets, DBS also. But REITs is a trust structure, and with that, it comes with corporate tax efficiency. That is the trade-off. And they expand through issuing rights. And when it's done right, it should be yield accretive. So again, compare REITs across its sector like all apples, and compare all other businesses like banks in their sector, all oranges. And also, they go through different cycles, so be very savvy on how you should deploy capital. And let's conclude with the article. Alternatives like the Singapore T-bills have fallen 2.75%, and 10-year bond yields are now at 2.7%. And this widening yield spread could benefit REITs no matter how temporary it is. This is in line with something I've mentioned before. As T-bills start to drop, people will be looking for alternatives. As REITs could benefit, and if some of the T-bills money does move in, you would expect share price to potentially pick up. So far, it hasn't happened yet. But now I prepared more information for you. This is the second article by DBS, and I also love a lot of things that he has mentioned. So let's read on together. DBS sees earnings shift for S-REITs despite high interest rates. It expects a DPU compounded annual growth rate for this year at 2.1%, signaling a recovery in investor payouts. Wow, we've seen for the last few years a cut in dividends, correct? But what they're forecasting is an improvement in dividends. Again, if T-bills start to pay less and REITs start to pay more, you would expect people to start to think, hey, it makes sense, correct? I cannot be all invested into guaranteed T-bills. Recent results by REITs have shown operational resilience, and growth momentum is expected to build this quarter. With capital management stabilizing, they believe that the worst may be over for the sector. I sure hope so. and a potential 25 basis point cut in Fed rates currently have not been factored into estimates, and that could drive earnings upwards by 1.2%. More importantly, that's why I boxed out in yellow, recent bond issuance by Frasers Centrepoint Trust and Mapletree Penitentiary Commercial Trust were at 3.1 to 3.3% only, suggesting cheaper rates are in sight. So again, REITs are not refinancing at 4, 5, 6%. It's only at low 3s. So again, if interest costs do not go up, that means REITs potentially can pay more to you. Historically, S-REITs have performed well during rate pauses and cuts, as seen in 2016 and in late 2023 and through early 2024. Hopefully this will repeat itself right now. DBS maintains a preference for retail and industrial REITs, citing resilient earnings and strong growth prospects. The bank continues to favor retail over industrial, followed by office and hospitality, with China-focused REITs and hospitality REITs likely to be early beneficiaries of lower rates. Personally, I'm a bit concerned about China-focused retail REITs like Keppel China Trust. There is also BHG Retail, there is also Sesol REIT, and these are the two names that's focused on China. But again, you must have the conviction on it. As of now, I'm still suggesting to stick to the blue chip ones, easier to weather downturns. Among DBS's top picks are CICT and Frasers Centrepoint Trust. Mapletree Industrial Trust and Mapletree Logistics Trust are preferred in the industrial space. Finally, a supporter for Mapletree Industrial Trust sounds like good news. S-REITs are currently trading at 0.8 times price to book and offer a projected 6.2% yield, translating to 3.5% spread over 10-year bond yield, slightly above historical rates. And this reinforces you need to compare apple to apple. Don't compare REITs to banks because again the nature is different. REITs to its own historical levels, you realize that there's many compelling reasons why they are undervalued. At this point, I'd like to draw up Hang Seng's index because it is something that has finally broken out from a bear market. China and Hong Kong investors have been suffering for 3 over years. You would see a 50% decline. And if you think back, there was a point where there was so much fear that China was uninvestable. Look where China is today. Would REITs finally break out? I do hope so, but I'm still patient about it. I cannot expect it to go up in a straight line also. And as always, Warren Buffett saying, the stock market is a device for transferring money from the impatient to the patient. If you're looking to trade REITs, I think maybe it's not the best idea. If you're looking to compound with REITs, then yes, it's the right match and it can help you build wealth towards your own retirement. And at this juncture, let me do a quick shout out to my own Georgetown CPF and Retirement Summit. I will be hosting it in SMU and we have sold out very quickly in our first event. Look out for 12th of April if you're keen to join in and learn a bit more. Links below and tickets are running out fast. Thank you very much, and with that, I'd like to introduce you to one of my previous videos on Frasers Centrepoint Trust. Singapore malls are something easy to invest into. With that, I'll sign off from here and see you there. Take care as always. Goodbye.